Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Well, today we're talking about several important topics, including asset allocation, the current macro scene, etc., with Chris Chapman, CFA. He is the head of global multi-sector fixed income at Manulife. He's been with the firm for nearly 2 decades. He earned his BA from Stonehill College and his MSF from Carroll of Boston College. So, welcome to Compound Insights, Chris.
Thanks very much. It's great to be here.
So let's start off with the macro. I think everyone's trying to see through the dust here and all the clouds and see what they see. So what do you see?
Yeah, certainly a lot to talk about in the macro space. I think, noise is a way to refer to it. There's a lot of themes at a high level that are percolating out there, but really the one tie that binds is what I would think of as kind of the main event as far as the macro themes right now, which is the US trade protectionism and, US policy more broadly. I think a lot of the other themes, which I'm sure we'll get into, really kind of tie back to this uncertainty that's been created in the market and across both the global economy and the potential impacts to inflation. A lot of these other ancillary themes that are out there that are weighing on different parts of the market really connect back and tie back into the protectionism, not just the potential extent. I say potential because that also we don't really fully know yet how that's all going to look when we come out the other side, but also the messaging and the way that it's been brought forth. The fact that this U.S. administration is going to be on the side of trade protectionism itself is certainly was a known thing coming into the year, but I don't think the extent and perhaps just the way it's been messaged and the escalation that we've seen, that was certainly not expected. And so that's kind of been the main theme in the macro space.
I also wonder if you include in that the questions that are going around all kinds of things like the heretofore dollar hegemony, other things. How do you sort of rank those things in there?
Yeah, so there's a lot of those other themes that kind of tie back into that. Yeah, so the big question mark about, has the US lost, is the dollar lost its status as the reserve currency related, has the treasury lost its status as the global risk-free asset, et cetera. And then related to that, but again, kind of overlapping the Venn diagram is just this idea of the end of US exceptionalism kind of more broadly. So yeah, a lot to talk about there. On the idea of the US dollar and related to the treasury, at the extreme, people wonder about, is this the end of the dollar as the global reserve currency? And I don't think that's the case. I think those changes can happen historically, and they do happen over time. You measure those generally in decades. So, but what you've been seeing, and I think what we're experiencing now, and I think, to be honest, I do think this does have some legs. What I think we will experience for a little while longer is really just an extension or perhaps, somewhat amplification of a theme that we've already been seeing really over the last 20 to 25 years, which is just the steady decline of the US dollar overall as a percentage of reserves. You can look at, for example, the IMF COFR data. 25 years ago, the US dollar was over 70%. More recently, it's been below 60. That's been slow and steady. What you haven't seen is one singular currency really pick up ground against it. Instead, what you've seen is really diversification. And so I think what you're experiencing now, and everyone's looking for the smoking gun data. We're looking through flows, we're looking through positioning, and you really haven't seen that smoking gun yet. So you're seeing some indications when you look at data, whether it's flow data from custody banks or other data vendor providers, et cetera. You don't quite have that smoking gun, but you're also pairing that with anecdotes that you're hearing from other investors, from other global participants. Diversification, as has already been happening away from the dollar, I think that's what we're experiencing and what we will continue to experience. And so US dollar, yeah, probably declines a little bit. It's still going to be the largest in the space out there, but on the margin, you do see people move to, the dollar block, for example, has been a beneficiary of that. Canadian dollar, Australia, other global high quality situations away from just the euro and the pound, and in Asia away from the yen. So I think you're likely to probably see some continuation of that, but I don't think we've seen the end of the dollar. The treasury as well, on the margin, people might look to maybe move a little bit away from the treasury on the margin, although some of the auction data, although it's been mixed, some of the auction data has kind of indicated there's still some, certainly some interest. But there's no other market that's big enough to absorb these flows. And so, look at the bond market, for example, it's 1/10 the size of the treasury market. JGBs, right? Obviously, there's a lot of JGBs out there, but the BOJ owns more than 50% of those. So again, similar idea. You can diversify, and I think we will continue to see global investors diversify, perhaps on the margin, away from the U.S. and the U.S. Treasury. But there's no singular place that can absorb this. And China, that's the other one that people look at, whether it's the renminbi from a currency perspective or Chinese government bonds. I just don't think China wants to be in that position, and haven't exactly made it as easy. So there's a lot of hurdles for that as well.
Right, there's still the difficulty of investing in China, which makes it real hard,
Yes,
for the lack of a better phrase. And I think they want it that way,
yes.
because it makes it easier for them to handle things like their real estate crisis.
Yeah, no, I would agree. I mean, while they have liberalized capital markets and you've seen index inclusion themes play out over the last few years, there are still controls. It's still not as liquid and free trading as, a lot of these other areas. So there are, those hindrances that might get in the way.
Right. So I would gather, well, I wonder what you think about this because when I was prepping for this and some other podcasts, I was thinking about what people used to say back in 10 and 11, which was that while the US federal debt, the federal bonds aren't as attractive, they're still the world's cleanest pair of dirty jeans.
The cleanest dirty jeans, you hear the cleanest dirty shirt is sort of the other yeah, the other sort of analogy. US fiscal and debt levels have been a known story for a long time. Harken back to your point of 2011 was when we saw that first downgrade. You think about it, it's been, almost 15 years. I think the picture is a little bit messier now than it was, or less clean, to keep with the analogy. So maybe the jeans are dirtier, the shirt is dirtier in 2025 than it was in 2011. To a large extent, though, it is comparatively maybe somewhat clean. But I do think if you have the flexibility, there are a lot of these other opportunities. Even you look at a country like Germany earlier this year with the new government, the expectation that you're going to see some fiscal stimulus, and so, goodness, that idea of supply that has been out there, that's been a problem for places like Japan, the US, frankly, but Germany's coming from a starting point. This is the first time for them really in forever to open up the purse strings. So, starting with a low 60% debt to GDP. So again, when you're thinking about clean, dirty shirts, like, yeah, Germany's going to be doing some fiscal stimulus, TBD when that really kicks in. But the story is the US shirt is maybe a little bit dirtier.
Right. And the other thing with the German stimulus is how much, right? It's when and how
Yes.
much, right?
When and how much that kicks in. I think the other thing that's important is that not all spending is going to be created equal. You look at US spending, Germany, in theory, at least the spending would be done largely that should have benefits to productive potential. And so you could make an argument that yes, the debt to GDP equation, there's two sides to that or two components to that equation. Yes, that debt level could increase, but so too could the GDP growth, which has been somewhat stagnant. Whereas in the US, borrowing debt to fund some of the things that we're funding, especially the increasing interest cost, that in and of itself isn't necessarily increasing U.S. productive potential.
Right. And one of the things that makes this difficult is, and from an analysis perspective, and I wonder what you think about this, is that the US is essentially 50 sovereigns, that have their own substantial budgets. And Germany doesn't work like that. So how
True.
does that
Yeah.
change, when you're doing compare and contrasting with other bonds, how does that influence the way you view this? Because the federal US federal government has an obligation over, say, healthcare funding to some degree, but a lot of the other things is the full faith taxation ability of states.
Yeah, but certainly that is a dynamic that is out there, and we see this in a lot of other areas as well. If you look at Canada, for example, the difference between the provincials versus the federal government, or the states in Australia, exactly, sort of where those obligations lie. So there are some similarities, there are some differences. Obviously, in the U.S. as well, the difference being, kind of the structure of the states, some being net recipients of kind of federal, some being, net paying in. I think on the grand scheme of things, you can sort of set that aside and you just look at the US budget holistically, where is the money going to be spent, and what are the overall obligations of the federal government itself? There is funding that does go to the state level. And if you're a participant, for example, in the municipal bond market, certainly you'd likely be a lot more attuned to those types of dynamics. But especially if you're a global investor, I'm not sure if that would factor as dramatically. And you just look at kind of the high level. What are the obligations? What is the U.S. going to be spending its money on relative?
Yeah, yeah, because the federal government does have flexibility. In my old bond rating days, we used to say the biggest risk to the state budgets was the federal uncertainty.
Yeah, no, exactly. And I think that, that theme is going to be one as well. One of the other themes that's out there in the macro space, of course, is the US fiscal scenario and the bill making its way through Congress. If they're going to find some reductions in spending, that will have an impact to states and certainly some more than others.
Yeah, that also is a little bit of a TBD also because they still have to go through reconciliation and it
Yes.
kind of limped through the House. So it's going to be
Just adding
interesting.
to adding to the uncertainty. There's just a
Exactly.
lot of
Exactly.
uncertainty in the macro space right now.
Yeah. Well, the other thing that's bringing some uncertainty around the world right now is this massive divergence that I don't think we've ever really seen in central
Mhm.
bank policies.
Yeah, it's an interesting theme. If you think about the last couple of years, you had, kind of going back, wind back the clock to COVID. You had us in an environment where you had a global shock that sort of caused all the central banks really effectively to do the same thing at the same time. And then coming out of that, similar experience. Inflation was a global phenomenon. And okay, yes, some banks moved, EM banks, for example, they tended to be a little bit more aggressive just given their experience with inflation. But generally speaking, you had a lot of central banks doing the same thing at the same time. And you're right, you're coming into a period, and really it started last year where you're starting to see a little bit of differentiation in terms of impacts to inflation, impacts to growth, where you look at something like the Bank of Canada, for example, they started cutting in June. They've cut 225 basis points so far. Contrast that, the Fed's done 100. You look at a lot of these other jurisdictions, um, they've done more, they've done less. They have the potential ability to do more. Also, there's a wide varying degree of expectations for what the banks are going to do. And I think that's a theme right now in the very short run because of all this uncertainty that we talked about, because of trade protectionism, because of U.S. fiscal, what have you. I think at least in the very short run, while we do expect divergence to continue as we go forward, in the short run, a lot of the banks, they're kind of in a similar boat just because they just don't know. Similar to the Fed, is it's sort of better to take a wait and see approach. In this medium term, a lot of the banks are kind of doing the same, but we do think down the road, because if you think about the trade protectionism, while there's a ton of uncertainty about it, at some point you're coming out the other side where the US is going to have higher tariffs than they would have previously had. And the expectation is it's likely to have, if anything, somewhat of an inflationary bias for the US. But the other dynamic that feeds into this potential greater divergence as we go forward is that if you think about China excess capacity, if it's not as much going to be going into the US, it has to find a home somewhere. And so while US-led protectionism might be inflationary or could have an inflationary bias for the US, for these other jurisdictions, that could actually be disinflationary. You look at Europe, you look at the UK. And again, so that while in the short run here, while we're all collectively, globally kind of waiting to see how things shake out, maybe central banks generally err on the side of caution. You might still see some, there's been a few that have been cutting. But as we move forward and we get more clarity through the later parts of this year, I do think that divergence kind of comes back in. One last thing I'd point out about this divergence as well has been within the emerging markets, because of the strength in the dollar that you've seen really up until fairly recently. That's put a lot of the EM banks a bit in a bind. And the example that I would give on that is Bank Indonesia. And inflation there hasn't been a problem. Now they were one of the preemptive EM banks. They hiked a bit more aggressively early in this inflationary period, and they've done a fair amount of hikes. They've done 275 since 2022 to be preemptive against inflation, and it did the job. Core inflation has averaged just about 2%. But so if you look at inflation, they'd have plenty of room to reduce rates. But what they've been doing really is also hiking in addition to try to protect the currency. Well, this environment, now that you've seen a little bit of the dollar pull back, it gives some of these banks like Bank Indonesia, they've only cut 75. It gives them more bandwidth as well. And so that's another thing that feeds into a bit of divergence. If you have a sustained period where the US dollar isn't as strong, the bandwidth for the EM banks, they have a little bit more room to cut, which all else equal, Indonesia is in an environment where absolutely they'd have room to cut.
Yeah, I mean, it is an excellent example, but it also shows you the values that some of them got from being first movers. Right. You know, so,
Right. No, absolutely. I mean, you think about, compare and contrast, U.S. team transitory from the
right.
Fed versus a lot of these EM banks who have, for them, for the U.S. inflation was 40 years ago.
Right.
For a lot of these folks, it's very fresh, very top
Uh-huh.
of mind.
Uh-huh.
And, some of them like Brazil, it also comes down to like the transmission mechanism, maybe for some of them isn't as strong. So they know they're going to have to be more aggressive anyway. So for them, they got to move faster, they got to move in larger size, and it's that combination. But absolutely, there can be those early mover advantages.
Yeah, yeah, it's exceptionally interesting. Well, this kind of brings us around to, with all of the uncertainty on all these levels, there's also been this call for, the changes to attitudes around diversification and asset allocation. And as we are here at CFA Study New York, and CFA takes asset allocation exceptionally seriously in all three levels. What do you think
Yes.
about that?
Yeah. So I think the big thing that comes to mind in a lot of conversations we've had with, investors and clients over the last few years is this idea, does fixed income still have a place in your broader portfolio allocation? And a lot of those questions come from the experience of 2022, where, fixed income didn't do what people would have thought all else equal in a textbook environment where it was risk off for equities. But it was because of the uniqueness of what was driving 2022. I mean, our view would be that in big picture, fixed income does still have a place to fit in your portfolio. I'll talk about a little bit of kind of a couple of nuances on that, but just going back to that 2022 because it's still very fresh in people's mind, given kind of the pain of that experience. It was really because it was all about inflation, as I mentioned, for the first time in 40 years. Inflation and the responding reaction, 425 basis points of hikes from the Fed, that hurt equities. Obviously, it also hurt bonds. The difference then and now as well was that you started 2022 with really no income to be had. If you had a crystal ball and you started 2022 and you knew the Fed was going to raise rates a lot, you'd go short duration. The two-year treasury at the start of 2022 was like 75 basis
Oh,
points.
wow. Yeah. Yeah.
Right. And so you're still looking at an environment, you end the year of 22 with a negative total
Right.
return, even if you did what all else equal would be the right
Right.
thing and reduce duration. So that was a bit of a uniqueness. Now, overall, I think, yes, inflation is still a question mark, but I think the difference being at least for now, we would believe you've definitely passed that kind of the worst of it. It's also a lot fresher in central banks' minds, so they wouldn't necessarily need to be as aggressive. I don't know that you're going to see another 425 basis points of hikes from here, right? You also have income to help offset that. That certainly helps provide it. But two other things I guess I would think about. If you look at fixed income returns, what has performed really well over the last couple of years, and where I think there might be some temptation to become maybe a little bit over reliant, is in riskier parts of the fixed income space. Now, it's been the right place to be. Like thinking U.S. high yield, it's been the right place to be. It's provided good return. But again, if we're talking about putting that CFA hat back on of portfolio construction, yes, you probably do want to own some high yield, but I would caution that there might be a risk that people get tempted by the returns that they've seen and the yield that might be on offer to put too much of the portfolio to become too reliant on that credit risk. And the risk of that being that, and we saw a very small flavor of this earlier this year when we had that post Liberation Day widening of spreads while equities were selling off. The risk for that would be if you have a proper risk off environment, your correlation of your high yield could be 75, 80% with the S&P from a portfolio construction perspective. So the point being there is, again, not necessarily would all fixed income be created equal, because you also do want to pay attention to the sector that you're participating in that.
Right. And there are some sector risks there. The massive rise in covenant light issuance, which moved everything into a different part of the analysis realm, meant the due diligence on high yield changed a lot, which you would expect to lead to some risks. And then there's just the increase in interest rates, which has made it exceptionally difficult for a lot of small companies to do anything.
No, exactly. And no, for sure. I mean, there's a lot of things, and you look at, some of the other spaces, you see some deterioration, and, you get the pick toggle type bonds where you have, you can get paid back with more bonds, which obviously is not necessarily going to be a great thing if, they're in a position where they have to do that. So yeah, there's those things. Valuations. Now, look, spreads have recovered from the wides post Liberation Day, and you're off the tights, but you're still relatively arguably rich still in generically speaking in high yield as well. So valuations also still not in a great starting point. So again, that idea of your within your portfolio, yeah, high yield can have a place. You just don't want to have too much reliance on that as your fixed income piece, because if you get a broader, we haven't had a credit event, or I don't want to call event, maybe it's too strong of a word. We haven't had a real kind of credit sell-off really for that, for a while. And people might be disappointed by, again, that fixed income isn't going to do what you're expecting it, because that's not going to be defensive against your downside versus your equities or Mag 7. But the other part of it to talk about as well, again, this theme I've said a few times, where not necessarily would all bonds be created equal, is also and it goes back to the theme of central bank divergence. Is it also could be worthwhile thinking about owning fixed income outside of North America, which for U.S. based investors, the home country bias is very strong with U.S. investors. There's been some studies. Morgan Stanley just had a piece out recently where over the last 20 years, it's, between 85 to 90% of US investors' equity and fixed income has been US, meaning only 10 to 15% has been outside of the US. So I think there's some opportunity as well to think about within that diversification. So you talked about asset allocation, but also diversification. That move away from home country can also have some benefits to it.
Yeah, I mean, this is one of the things that I think it's a little funny about the asset allocation discussion right now is there's some pretty good values in EM. It's it's exceptionally interesting area.
Yeah, I mean, EM has some interesting areas. I mean, Indonesia, like we've talked about, I think has some interesting stuff to it. I mean, even in the developed market, post inflation impact in the developed market space, you're finding yields that are fairly attractive for high quality options, where, something like Australia, there are opportunities there where your yield pickup relative to the US is what we would believe to be fairly compelling for something where you think about your credit risk is pretty much the same, double A rated. If you look at like something like the semis, so whether maybe like TCV or New South Wales, that kind of thing, there are those options where you can find, even not having to branch out to EM, but to go global with other high quality, and you can find pretty interesting opportunities for fixed income, for high quality fixed income away from the US.
Yeah. Are there other values that you're looking for around in a broader stage around debt? Are there other sort of opportunities? Because we've talked a little bit about EM and high yield, but are there other ones that you're all looking at?
Yeah, I mean, I guess maybe to dig a little bit further into the international space. I mean, I think, some of those opportunities really are interesting, where it's not just US Treasury yields that have reached levels they haven't seen in quite some time. That has been the case for a lot of these other areas. And so if you're looking for, riskier assets, kind of dial back a little bit. High yield, I mentioned, kind of where those spreads are relative, riskier assets, okay, they're a little bit more interesting than they were maybe at the lows earlier this year. But I'm not sure you necessarily want to be all in on high yield at this stage, but you can find interesting return opportunities where your potential total return, again, if this idea of central bank divergence plays out, where some of these banks, Australia, again, to that example, they've only just started a rate cutting cycle, to this idea of divergence. And you can think about the connectivity the Australian economy would have to a place like China, which is facing some challenges regardless of trade protectionism. They're already in a bit of a tough spot. And so, there's some opportunity there where, the yields we would believe look pretty interesting. You have some potential where the bank can be, continuing to ease maybe a little bit more than some of their other compatriots. And then that currency side as well, if this is a period where perhaps the US dollar is on a bit of an extended downward trend, again, for a US investor, you have the potential for some additional total return from some of that foreign currency exposure.
Oh, yes, of course. Yeah, yeah. Well, thank you, Chris. This has been fascinating. We've been around the world twice.
No, I appreciate the opportunity. Thanks very much.
All right, so head over to Manulife's website. You can find out some of the things that Chris has written and go into a little more detail on this. I would also just like to mention to everyone listening to this podcast, we talked a lot about high yield. Well, in just 3 days, CFA Society New York will host the 35th annual High Yield Bond Conference. Now, members can still sign up for it. So if you have not yet and you're interested in hearing about a whole day of some of the things we talked about, including some what the rating agencies are seeing in covenants, where portfolio managers are finding things now, please have a look at that on our website at cfany.org. Until next time, I'm Rob Rowan, and this has been Compound Insights.